Good morning. I'm Alderman Vincent Keavney, Lord Mayor-elect of the City of London. I'm delighted this morning here at GHS at COP26 to be moderating our opening dialogue of the morning, discussing whether without globalised, harmonised standards, litigation risk is a major barrier to mobilising private capital, the big challenge of the day. Joined by JP Douglas Henry, Managing Director of Sustainability and Resilience at DLA Piper, and Natasha Landell-Mills, Head of Stewardship at Sarasin and Partners and a member of the Carbon Tracker Advisory Board. Well, JP, Natasha, big announcements yesterday from the IFRS, the International Sustainability Standards Board being set up. First, I'd like to go to Natasha to ask you to share your views on the need for internationally comparable sustainability standards to drive increased private finance into green investments. Natasha, are we making progress on this?
Well, I think, as you've mentioned, we're certainly making big progress with the announcement of the ISSB being set up. I think that's a very good step forward. But I guess what I would say is if at the end of the day, what we're really, really interested in is a system-wide and urgent shift in private capital into greener activities, then what we need to do is to look also at the accounting framework. In other words, the set of standards that governs how financial statements are drawn up. And I say that because in the end, it's the accounts, it's the numbers that drive where capital is deployed, either at a corporate level, but also actually by investors in the financial markets. We look at accounts to see where we're going to deploy our clients' capital. And right now, we have a problem where, to a large extent, and this has been shown in a carbon tracker report that was released very recently called Flying Blind, to a very large extent, those financial statements are leaving out material climate impacts. And the result is that capital is being deployed in a way that is therefore ignoring those impacts and arguably making the situation worse. Now, why I say we should be focusing there, first and foremost, is we have an existing set of standards, and therefore there's no need for new standards. Today, we can actually start to implement and enforce those standards properly to make sure that capital shifts very quickly.
Natasha, thank you. JP, a challenge there, Natasha, on the we have standards, Natasha is saying, but they're not being enforced effectively. Well, any views on that?
Well, we do have standards. We've had IFRS accounting standards since the Great Depression. The difficulty is they measure financial impacts in a way that looks back to the world we used to live in rather than the world that we are living in and that we're going to venture into bravely and boldly. And we need capital to invest in green companies, in green business. We need technology providers to innovate, to provide solutions in a climate context. And the impact of those investments cannot be measured in the same way as investors are used to assessing the impact of deploying capital in traditional ways. This is a new world we're living in. Or an old world that we've just woken up to, but we're applying an ESG lens to it, and it requires new standards. But it's worth just pausing and reflecting on one thing. Green investment is at record levels today. In 2019, it was at $21 billion. In 2020, it was at $51 billion. Morningstar. Bloomberg Intelligence estimates that a third of assets under investment are going to be ESG assets in 2025. What about the other 2/3? When you invest in a green business or a green venture, the stats show that the private capital world piles in. But when you're in the middle and you're looking at transition, businesses in transition, going from brown into light green and then hopefully into dark green, you've got a whole set of risks there that you have to balance, and you've got a stakeholder community that is going to hold you increasingly to account. And unfortunately, we've heard lots of talk about the alphabet soup of sustainability frameworks, ratings, disclosure regimes, it's really hard for business to take a view in the way that you can when you sit down using the accounting standards and say, well, I know whether this company is going to make a profit or not, because I can use the old-fashioned metrics to work it out. What's the EBITDA? You can project it. It's much harder when you're looking at transitional investments, and where do we need most money to go? It's in the transitional space, particularly in emerging and developing markets. So I think we do need a set of new standards to drive green investment, but in particular, transitional investment. And I welcome the announcement by the IFRS yesterday. Tremendous news.
Yeah, it was a day of big announcements, and that I think was a very significant one. Natasha, in your role at Sarasin, you steer the ESG matters in the firm, a lot of the investment policies around that. What is your view in relation to the standards on that transition pathway? How useful are they in that process?
Well, if I may, I'd just like to come back on a point earlier, because I think it's a really, really critical point on the financial statements, which is they're not backward-looking entirely. In fact, most of the critical accounting assumptions that go into drawing up your balance sheet, your P&L, are forward-looking. And that is precisely why the omission of decarbonisation pathways, the omission of a pathway down to net zero by 2050 being ignored in these financial statements is so critical. And if I may, I'll just give you an example, because this is so important. If you have an oil and gas company, for instance, one of the most critical accounting assumptions that they have in drawing up those financial statements is a forward-looking commodity price assumption. So their future expectations of where oil and gas prices will be. And those are long-term assumptions. And what we found through our analysis was most of these companies, and I'm thinking back 3 years when we started looking at this, were ignoring decarbonisation entirely and assuming those commodity prices would be $70, $80 and rise into the future by 2% a year by inflation. Now, if you assume that, then of course it makes sense to continue to deploy more capital into those activities because they're profitable. But if you assume, and increasingly they are doing this because they've been responding to investor pressure, that actually prices will not be going up in a decarbonising world. And if they come down to, for example, BP has come down to $55 a barrel now, then you recognise impairments. And actually then your capital is impaired and actually you're less profitable. And that then means that you will deploy less capital into those activities and you'll look for more profitable activities. So it's not right to say that financial statements are backward looking. They're very, very important for the deployment of capital going forward. Now, to JP's point, you're absolutely right, and I couldn't agree more that we need to get capital going into those transition activities. And I couldn't agree more also that there's a real danger at the moment with the way we have ESG labeling or standards that almost, sort of villainize the sort of transition activity and encourage more money to go into renewables, etc. Of course we need that. There's no doubt we need it. But as JP has mentioned, we also need funds to be going into what are now the very polluting industries to allow them to transition. And it's that transition that's going to deliver the reductions in carbon.
JP, I think we see the role of accounting standards, the role of these disclosures, but there's an element of teeth here as well. Your background as at Delay Piper is as a litigation lawyer. You've seen litigation, both acting for claimants and acting for defendants. What sort of litigation do you think we can expect to see in this area developing over the next few years?
Well, the short answer to that question, Vincent, is more, and in all shapes and sizes. There is hardly a corporate action in a US-listed company that isn't accompanied by a US securities action, very often a class action. And the EU's just brought in the Collective Redress Directive, which is going to replicate US-style class action jurisdiction across 27 member states over the next couple of years. So in our own backyard, we are going to see, I think, a replication of the US landscape, litigation landscape. I think we're also going to see more arbitration. I think we're going to see NCP complaints, OECD claims, and state-on-state and investor-state claims. But if you drill down to what businesses' role is in deploying private capital and what the brake is on the injection of that capital into green investments, and put yourself in the shoes of business today, you're in a really difficult position. What is the price of emissions? There's no carbon price yet, no universally accepted price for carbon. There's no carbon trading framework that is universally accepted yet. Watch this space. We've got another week and a half to go. And what's the price or value of mitigation? Because those are the two things that you need to trade off. And I come back to the point I made about alphabet soup. And Natasha, you're absolutely right. Accounting standards don't look back. The point I was making is that the existing accounting standards look back to an era that did not contemplate what we now see. The code red warning to humanity. This is a very difficult position for business to be in, where they have to balance opportunity and risk, and are being encouraged by governments all over the world to transition and to make investments. Yet at the same time, we have legislators and regulators bringing in a plethora of different frameworks, regulatory frameworks. We have private sector rating agencies coming in with multiple ESG standards. We have voluntary and mandatory disclosure and reporting regimes. If you're a global business, and you have to navigate all of those things and make your decisions about where you're going to deploy your capital and then make disclosure about how green you are, it's really difficult. If, on the other hand, you're an activist and you want to put pressure on where the G20 can't deliver, and hopefully they will in increasingly meaningful ways, then greenwashing is where you'll go, and you have a third-party funding market with unprecedented levels of capital that they're going to be putting into these sorts of claims. And we've already seen this. Think Netherlands, Hague, and some decisions coming out of that particular jurisdiction at the moment that I think we're going to see replicated around the world.
Natasha, how do you think of, where do you factor in the litigation risk into your thinking as an investor in the sector?
Yeah, no, I think it's a really interesting question because in some ways I see litigation risk coming the other way. In other words, as we've seen, for instance, with Shell and we've seen in certain instances in Australia, you have cases being brought against corporates and indeed big asset owners, investors, for their failure to invest in a way which is aligned with the Paris Climate Agreement. So in other words, they have a duty to their constituencies to make sure they're taking these impacts into account and the impacts that they're having on society into account. Indeed, under company law in the UK, under Section 172, directors are compelled to have regard to the environment and the societal implications, so that there's, and I don't believe it's ever been the subject of litigation, whereas maybe JP can tell us, but certainly it's there in the Companies Act. And then what you had in the Netherlands in this recent case against Shell, they were making reference, invoking the human rights, international law regarding human rights. So I think there's actually increasingly an awareness in boardrooms, certainly. Shell actually described that litigation risk as very improbable in their annual report and accounts before the decision came out against them. So I think that's a wake-up call for that, but also for investors. We have now a very, very large group of investors. We heard Mark Carney yesterday that 130 trillion, I believe, now saying they'll be net zero aligned. Now, how are those commitments going to be delivered? And if they're not, are there litigation risks associated with that?
Litigation, of course, has a positive side to it too. I mean, it provides a remedy, very often quite an effective remedy for the litigants involved. I mean, your views on that? You see a positive role in.
Well, I do, and it builds on the point I made about the reality gap between what business wants to do and what it's able to do, intermediated by an alphabet soup of confusing, sometimes conflicting and inconsistent legislation and regulation. I think we are going to see a shift from the sorts of litigation that Natasha mentioned, where governments and corporates are held to account under the Paris Agreement. Those sort of claims will continue. And the Shell decision is subject to appeal, and it'll be interesting to see what the outcome is. I think we're going to see a shift from that into the very space that Natasha touched upon, the duties that directors owe to take into account environmental and social considerations. I'll come back to social in a minute. So this isn't just about climate. Investors are going to be looking at making claims where they invest in businesses or products that turn out not to be as green as they were said to be. And depending on who they are, activist claimants, they'll want declarations, they'll want injunctions, they'll want to move the position on. If it's an investor who's lost money, they're going to want damages. Once you get a body of law built up and some precedent that can be relied upon, a bit like the global financial crisis and the rules on closing out interconnected transactions under swaps, for example, that is a form of regulation, and it will fill the gap and hopefully provide some greater clarity. Let me come back to the point about it's not just about climate. If you're making an investment in a company that is providing green products to a marketplace but has a supply chain that has modern slavery in it, you'll win on the climate piece. So it's not greenwashing, green, but it's still a breach of the director's duty to take into account environmental and social obligations. So I think we're going to move from greenwashing to ESG washing. That's the future.
Well, that's
a litigation.
That's it. That's it. Well, I suspect as a former litigator, it's probably, if nothing else, there will be plenty for you and your colleagues to think about in that space, and plenty for Natasha to think about as well as an investor. So we're coming to the end of the session. I think it's been a really interesting discussion. Thank you very much, Natasha. Thank you very much, JP, Jean-Pierre, for your contributions. We're going to hand over now to a short piece from John Glenn, the Economic Secretary to the Treasury. Thank you very much, ladies and gentlemen. Thank you very much.